Welcome back. Foreclosures and delinquencies are rising in the US as mortgage rates have been climbing, saving rates are dwindling, and credit card balances of Americans are at record high levels. So, for example, this has caused a big increase in late payments for a loan type that's very popular amongst first-time homebuyers. So in today's video, I'll share all the details, so thank you so much for joining me. And by the way, a lot of research goes into making videos like this one, so please hit the like button and also consider subscribing as well if you haven't done so already. Thank you so much for doing that, and let's begin today's video. The first report I want to share with you guys is from the MBA, which covers the fourth quarter of 2023. I know that was a little bit a couple of months ago, but this is actually just posted last week here. They talk about the delinquency rate for loans or mortgage loans by loan type and also overall as well. So for the fourth quarter of 2023, the delinquency rate of mortgage loans actually increased to a rate of 3.88% of all loans outstanding in the fourth quarter last year. This is based on their survey here. This rate was an increase of 26 basis points higher than the third quarter of 2023, but down 8 basis points, which is 0.08 percentage points from 1 year ago. You guys may think here that, yeah, okay, well, they have a big increase compared to the previous quarter, but down year over year. Here's a kicker here, though. The historical average for overall delinquency rates for mortgages here from 1979 through 2023 is at 5.25%. So the rate right now at 3.88% is still historically low, but here's the kicker here though. It says here FHA delinquencies surged by 131 basis points or 1.31 percentage points. That is a loan product in which you only have to put down 3.5%. It's especially popular with first-time homebuyers. Also, the minimum credit score in order to qualify for an FHA loan is quite a bit lower compared to a conventional loan as well here. So a big increase of FHA delinquencies or late payments up by 131 basis points. And I'll share a graph here as well with you guys because the rate for FHA right now is more or less at a 10-year high when looking at pre-COVID levels here. The percentage of loans on which foreclosure actions were started, in other words, the foreclosure process has been started for people who are late on their payments here during the fourth quarter remained unchanged at 0.14% here. Here's something to keep in mind here because it says mortgage delinquencies increased across all product types for the second consecutive quarter here, with the overall delinquency rate is still very low compared to the historical averages here. The pace of new loans entering delinquency, in other words, becoming late on your payment here, picked up, and some loans moved into later stages of delinquencies here. The resumption of student loan payments, robust personal spending, and rising balances on credit cards paired with declining saving rates are likely behind some borrowers falling behind on their payments here as of the end of 2023. By the way, regarding student loan payments, that resumed back in October last year. And I actually noticed that CNBC News reported that according to the Education Department, about 40% of borrowers who owed a payment in October when student loan payments started again, failed to make that payment by mid-November. So if you guys recall, we had this moratorium on paying back your student loan debt, but that actually just started again, the repayment process in October, and about 40% had not made a payment by mid-November. In regards to rising credit card balances, take a look at this because here's a look at credit card balances in the US here. And right now we're at $1.3 trillion. The most recent month we have is December last year, $1.314 trillion in credit card debt. an all-time record high going back to the 1970s. And by the way, if you guys are curious, during the Great Recession here back in 2008, it didn't surpass 1.1 million. To be exact, during the Great Recession, it was around 1 trillion, I should say, $1 trillion dollars in credit card balances. Now we have $1.3 trillion as well. Not only are we seeing a huge increase in credit card balances, though, we're also seeing a huge increase in delinquencies on credit cards as well, late payments on credit cards. So the rate for credit card loans is at 2.98%, has been increasing ever since Q4 of 2021. Also at 2.98%, this is higher compared to pre-pandemic levels. So for example, in Q4 2019, that rate was only 2.62%. Now going back over the past, let's just go back as far as we can. So 2.98%, this again is higher compared to pre-pandemic levels. Looking back at pre-COVID levels, actually even post-COVID as well, 2.98% is actually the highest rate of late payments of credit cards since Q1 of 2012. So big picture here, not only are we seeing record high levels of credit card balances, but the late payments here, the highest rates we've had going back to 2012 as well. Now going back to the MBA's report here, saying that we have declining saving rates here. We also can see that by looking at our good Uncle Fred here again. And the source here is the U.S. Bureau of Economic Analysis. And by the way, I'll provide a link to all these reports in the video description below here so you guys can have a look at it for yourself as well. So the personal saving rate is only at 3.7% right now. This is well below the historical average, I believe is at 8.4%, going back to the 1970s here. But at 3.7%, the personal savings rate is at very low levels. So for example, when looking at pre-pandemic levels at 3.7%, this is much higher compared to January 2020 at 7.2%, and also in February 2020 at 7.7%. So what does this really mean here, right? At 3.7%, this means that everyday Americans on average are only saving about 3.7% of their income right now, well below pre-COVID levels. And this, of course, is impacting late payments on loans as well, of course, right? It says the labor market is still quite resilient with the unemployment rate still correlated with mortgage performance. So because our labor market right now is still robust, this is one of the reasons why we've been seeing a lack of foreclosures in the US, and of course, due to high home prices or rising prices as well. But any weakening in employment conditions would likely lead to more borrowers falling behind on their payments in the coming quarters. So here's the chart I want to share, because here's a look right now for all loan types. These are all mortgages, FHA, VA, conventional, etc. Is the green line right here. So overall, the rate is at 3.88%. which I explained is much lower than historical averages going back to 1979 at 5.25%. But the stats here vary quite a bit when breaking it down by loan type here. So conventional loans, very low at 2.6%, but FHA, look at this, 10.8%. The delinquency rate there, much higher compared to the overall rate at nearly 3.9%. On top of that, at 10.8%, when excluding post-COVID numbers here, at 10.8%, just eyeballing this, that's actually the highest level since approximately 2013. By the way, you guys may have noticed here a huge spike during the early parts of 2020. This is really due to the fact we had COVID lockdowns back in, when was that? April 2020. And back in March of 2020, Congress actually passed the CARES Act. And the CARES Act did a lot of things, right? One of the things was a foreclosure moratorium, but also allowing people to enter into a mortgage loan forbearance, in which you got permission from your lender to stop paying your payment for up to 18 months. So this spike right here is really due to the fact that a lot of people entered into forbearance, and that's why the rate here spiked in early 2020. But once people started falling off of the forbearance program, right here, it started to decrease. But again, right now, increasing right now at 10.8%, or the rate right now at 10.8%, the highest rates we've had for FHA loans in over 10 years. So why is the percentage of FHA loans so much higher compared to conventional loans, for example? So FHA loans only require a down payment of 3.5%. And also, again, you can get a FHA loan with a lower credit score compared to conventional loans. So overall, the lending requirements for a conventional loan tend to be a little bit tighter or harder to get compared to an FHA loan. So because of all these factors here, this is one reason why we're seeing more late payments for FHA loans compared to conventional loans. So that's what's going on for the fourth quarter last year. Let's have a look at January this year from a new report just announced a couple of days ago from ATTOM, or ATTOM. It says U.S. foreclosure activity sees a notable increase this January. They talk about the foreclosure rates for each of the metros and also the states as well. So I'll share that with you guys here in a little bit. It says here, posted on February 13th, ATTOM, or ATTOM, released its January 2024 U.S. foreclosure market report, which shows there was a total of 33,270 U.S. properties with foreclosure filings. In other words, default notices, scheduled auctions, or bank repossessions, up 5% from January 2023, and also up by 10% compared to the previous month. Now, this a huge increase in January, up by 10%, is touched on by Rob Barber, who's the CEO. But basically, lenders tend to not want to start the foreclosure process during the holidays in December. So it's more normal each and every year to see an increase in January compared to December here. He said here, we observed a slight uptick in foreclosure filings, which may be partially attributed to the typical post-holiday progression of filings through the legal system. However, other external factors may be at play, such as escalating interest rates, inflation, employment shifts, and other market dynamics. So overall, lenders repossessed nearly 4,000 U.S. properties through completed foreclosures, or REOs. An REO is a real estate owned property. That was up 1% from a year ago and up again 13% from December. The states that had the highest amount of foreclosures in January this year were Michigan, up by 200%. Then we have Minnesota, California, Pennsylvania, and Missouri. Among the 224 metro areas that they follow, with a population of at least 200,000 people, the greatest number of REOs, or real estate owned properties, foreclosures, were actually in Detroit, Michigan, Chicago, Illinois, New York, Philadelphia, and San Francisco, rounding out the top 5. In regards to foreclosure filings, the states with the highest foreclosure rates were Delaware, where we had 1 in every 2,269 housing units had a foreclosure filing. Then we have Nevada, Indiana, Maryland, and New Jersey. In addition, lenders started the foreclosure process on nearly 22,000 U.S. properties this January. That was up 6% from December and up 5% from January of 2023. The states that saw the biggest increase of foreclosure starts. A foreclosure start is basically the beginning of the foreclosure process. In other words, the home buyer or the homeowner is behind on paying their payment, and therefore, after a set period, a number of months or days, the lender starts the foreclosure process, which can take a year or two. It can take a long time. Anyways, the start of these foreclosure starts here, or the beginning phase here, in January, the biggest numbers here were actually in California, Texas, Florida, New York, and Illinois. One of the reasons why we have more foreclosures in these states, of course, is because they have a higher population, of course, right? Comparing California to New Hampshire, it's night and day difference. We have a lot more people who live in California compared to other states. That's one of the reasons why we have these high numbers here. But among these major metro areas that they track here of a population of at least 200,000 people, the greatest number of foreclosure starts in January included New York, about 1,500 foreclosure starts. Then we have Houston, Texas, Los Angeles, California, Miami, Florida, and Chicago, Illinois. And by the way, if you guys are interested in learning about how to purchase a foreclosure or a short sale, I made a video several months ago about the pros and cons about how to buy a foreclosure, and also the steps if you guys are interested in purchasing one, and kind of like the my warnings to you guys as well. So I'll leave a link in the video description below here if you guys want to take a look at that video. Now, speaking of that, if you guys want to find out foreclosures and foreclosure auctions in your area, one thing you can do, of course, you can contact your local real estate agent. So if you go to Zillow.com and just actually click on your area or just type in your area. In my case, I'm looking for Sacramento County, which actually is a population of over 1 million people. Now go to, make sure you're only looking at houses for sale. Click on this link right here, which is more. And then this is right at the top here. Click on show more by listing type. We want to look at this right here, foreclosures, auctions, and foreclosed properties. What I exclude here is pre-foreclosures. So according to Zillow here, a pre-foreclosure is when the lender has initiated the foreclosure proceeding or has initiated foreclosure proceedings on these properties because the owner or owners were in default on their loan obligations or on their housing payment. Pre-foreclosures also include properties for which a foreclosure auction is scheduled. So I exclude these because these could be simply a notice of default was recorded with the county in which the homeowner is at least 90 days late on paying their payment or paying their mortgage payment. But it does not mean it's going to become a foreclosure. And if it does, it could take weeks, months, or even years to become a foreclosure. So I actually would just kind of exclude these. These are houses not for sale. It just means that the homeowner is behind their payment, but they could become current on their payment here. In any case, just look at foreclosures, which are REOs or real estate owned properties. These are houses that are owned by a bank or lender and are listed typically by a real estate agent. You could see these on Zillow, Realtor.com, Redfin, etc. Auctions are just that, auctions. And foreclosed properties are those properties that are owned by a bank or a lender, but they are not currently listed for sale. So after clicking on those three right here, click on apply and let me know what you guys find in your neck of the woods here. But in Sacramento County, again, a population over 1 million, a giant area here, there's only 19 properties that are in foreclosure or are in auction status. So a very limited amount of houses actually being foreclosed on here in the Sacramento area. So even though there's a very limited amount of houses that are foreclosures here in Sacramento, that could increase if our labor market starts to show signs of cracking here. Because I've been saying this over and over again, we're not going to see a huge surplus of new listings, in my personal opinion, unless rates were to decrease greatly, big time, and that's not going to happen anytime soon, given the hot jobs market, for example. We're not going to see a huge uptick in new listings anytime soon. But if people start losing their jobs, we will likely see more short sales and foreclosures in the months ahead here. Time will tell, and I'll definitely keep you posted with latest developments. And again, if you guys are interested in buying a foreclosure, check out that video in the video description below. I appreciate you guys for watching today's video. Like, share, and subscribe. Have an awesome day. I will see you in the next video.